Hello students, welcome to Accounting Explained at Account-Wise Academy. This is Latha Venkateshwaran. In today's video, we are going to see an important exam question on traditional payback period. Today, we are going to solve a full-fledged exam question. And this is the question 3 which we are solving for traditional payback period method. The question is as follows. Rahavi Limited is producing articles mostly by manual labor and is considering to replace it by a new machine. There are two alternative models X and Y of the new machine. Prepare a statement of profitability showing the payback period from the following information. So the information is they have given machine X and machine Y. Estimated life of the machine for X it is 4 years, Y it is 5 years. Cost of the machine is 1,80,000 for X and for Y it is 3,60,000. Estimated savings in scrap for X it is 10,000 rupees and for Y it is 16,000 rupees. Estimated savings in direct wages for X it is 1,20,000, for Y it is 1,60,000. Additional cost of maintenance for X it is 16,000 rupees and for Y it is 20,000 rupees. Additional cost of supervision for X 24,000 rupees and for Y 36,000 rupees. This is the question, and before going to the solution, I'll teach you how to solve the question. First, we have to take the savings. Savings on buying machine X and machine Y. What do we get? Estimated savings in scrap and estimated savings in direct wages. So these savings should be added and kept separately. That is called as A. Then expenses on buying machine X and machine Y. What are the expenses? Additional expenses which we incur on buying X and Y machines. Additional cost of maintenance and additional cost of supervision. So expenses should be added and they can be named as B. Now we have to deduct A minus B. You will get net cash inflow. Okay. From net cash inflow we can find traditional payback period easily. Okay, now let us take the savings. Now for the solution we open three columns. Particulars, machine X and machine Y. First savings. What are the savings? We saw estimated savings in scrap. We have taken here. And machine X it is 10,000 rupees. Machine Y it is 16,000 rupees. Next, estimated savings in direct labor. We have taken here direct wages. It is 1,20,000 for X and 1,60,000 for Y. On adding these two, you get total savings A. For machine A, it is 1,30,000. For machine Y, it is 16,000 plus lakh and 60,000 is lakh and 76,000. That is named as A. This is what we have seen here. See, A. Next, we will take the expenses part. Expenses is additional cost of maintenance. We are taking in this column and the expense are 16,000 for X and 20,000 for Y. So we have taken 16,000 and 20,000 in the solution. And additional cost of supervision. Take it to the solution. Additional cost of supervision. For X it is 24,000 rupees and for Y it is 36,000 rupees. 24,000 and 36,000. On adding these two expenses, we get total cash outflows and we name them as B. See here, B. Okay, adding the expenses, we get 40,000 for X and for Y it is 56,000. Now we have to calculate total cash inflows. A minus B. 1,30,000 minus 40,000, it is 90,000 for X and 1,76,000 minus 56,000, it is 1,20,000 for Y. The payback period formula is original investment divided by annual average cash inflow. So we know the average cash inflow, no? Total cash inflow we found out previously. It was 90,000 for mission X and 1,20,000 for mission Y. Okay, for mission X, it is original investment divided by annual average cash inflows is the payback period. This we have taught in a very elaborate manner in the part 1 video. I'll be sharing the link in the description box. You can go through it for a thorough understanding. So original investment here is cost of the mission is original investment. Cost of the mission is 1,80,000 divided by cash inflow. How much it is? 90,000. So 1,80,000 by 90,000 is 2 years. Mission Y, cost of the mission or original investment is 3,60,000 and inflow it is 1,20,000 divided by 1,20,000 is 3 years. Mission X should be preferred because it has a shorter payback period. So mission X should be selected. See here, mission Y, though it has higher cash inflow, payback period is also higher. So we cannot close our eyes and say that a project which has higher cash inflow can be taken. Okay, but the answer has become topsy-turvy now. Now the answer is mission X, though it has only lower cash inflow because of the lesser initial investment. Mission X is preferred over mission Y. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.